All right, welcome back, everybody. This morning, KKR is out with its 2023 outlook. The global investment company is forecasting periodic bouts of dislocation in the new year and is advising investors to accelerate from a walk to a jog for deployment. Joining us right now in an exclusive interview is Henry McVeigh, which is KKR's Chief Investment Officer of Balance Sheet. Henry, let's just talk about this. When you say get to a jog instead of a walk on this, what kind of deployment are you talking about? Right. You guys like credit better than stock right now.
So I think last time we talked, we had used the analogy walk, don't run, and we said there were some storm clouds. So I was trying to make a reference that maybe once we get through January, I think you'll get a pretty disappointing outlook in terms of where earnings are going. But after that, I think it's time to start to lean in. I mean, what's happened? 2022, 84% of the big central banks around the world were tightening. Next year, that'll be 12%. That's a huge change. Second is a lot of institutional investors have de-risked pretty mightily. They've lost money in growth stocks, they've lost money in bonds, and they've lost money in stocks. So the technical backdrop is pretty interesting. If you think about supply, if you take IPOs, levered loans, and high yield issuance, and you look at that as a percentage of GDP, it's back down to the level of June of 2009. So ultimately, we're healing ourselves. It's not going to happen overnight. We've been using the analogy internally of kind of 2000, where a lot of equity got burned up from high dot-com prices. And then 2002, you had some credit issues around telecom. But if you used that sell-off in telecom to buy other parts of the market that were stable with good earnings, you actually made a lot of money. And so we actually are getting more enthusiastic about where we're headed.
And this time around, the equivalent analogy, SPACs, Bitcoin, what's sold off in the early year?
SPACs have gotten hit, IPOs have seized up. Really, there was an excess of venture capital investing, and they were probably accessing the public markets too early.
What does the telecom equivalent of next year look like? What would that be?
I think we need to watch around, I think you're going to see some consumer losses around provisioning. Banks will show that. Also, real estate around office, I think, is back to work. Maybe doesn't surge back the way some people think. There's a lot of people that own a lot of office around the world where the footprint is changing. You look at Midtown versus Hudson Yards, they're very different outcomes probably. So I think those are two areas to focus on. Look, we own over 200 companies globally. We watch the data there. The one thing that I've heard you all talking about earlier today is wages are probably the thing that we're watching the most as a potential impediment to inflation cooling. That's something we should all stay focused on. The offset of that is the goods world is finally deflating. Last time we had talked about walk, don't run, because inflation was going to be higher. We saw that in the labor, we saw that in the rental income, and we saw that in goods. Now we've got goods actually deflating. Think about Target missing, those type of companies. We still have wages going up, but rental income is starting to peak. So you're going to enter this world next year where you have goods deflation, but you still have services inflation. And so that's the tension we're going to feel as investors.
What's the pullback that you'd like to see? If you think that this is an earnings recession that we're actually going to see in the first quarter, what kind of pullback do you need to see in the averages before you think this is?
So there are a couple points I want to make. One is, I think, look, I've been doing macro for a long time. Every time one sector becomes a huge part of the market, it generally underperforms and it hurts the index. Energy in the 1980s, tech in 2000, financials in 2007. Tech is set up for that right now. It's 29% of the S&P. Everybody owns it. You were just talking about re-regulation with Jim Cramer. Law of large numbers, re-regulation, those type of things. So I think the S&P is actually not going to perform the way that it used to.
A lot of those big tech companies have already seen pullbacks of 50%.
I think there's more to come.
I
think you could have some of the bigger names still get hit. Wow. And then to me, what's interesting is think about the Russell 2000. It's the cheapest since in decades. Relative to the S&P, that's interesting. We think the dollar's peaked, so that probably means you need to add a little more emerging markets or some Europe to your portfolio. Everybody's standing on one side of the boat right now.